Hey, good morning, everyone. Marty Mazzora here, Friday the 13th of October 2023. With your end of week market snapshot, I'm going to keep this one quick. I wanted to just get this one done and out to you, and then it's going to be a pretty full day just getting into the economy and the data this week. Bank earnings are out this morning. They were very good. We generally find important insight into the state of the consumer, inside of what the banks themselves have to say about the state of their businesses and what their outlook is going forward. I caught just the kind of clip from JP Morgan's Jamie Dimon this morning, where after reporting just really good numbers, really killing it on their net interest margins and so forth, as you might expect, and then saying this is as dangerous a time as we have seen in the last several decades. I believe I quoted that correctly. So as you know, we would agree with that, certainly when it comes to asset markets going forward. However, folks, as I'm going to show you in the technicals, and as I've been showing you of late, and as we reported in the narrative that we shared with you for our own equity market conditions index, which we use internally, due to the proprietary nature, we don't give you all of our analyses, or at least not publicly on the video, in terms of the 12 components. But I do kind of give you that intro narrative, and I do tell you what improved and what deteriorated. And like I said in a very recent video within the last week or two, I think if you get the dollar right going forward, you are going to get a lot right with regard to asset prices in the next cycle. And our view is that the dollar will be on a downward trend, a multi-year downward trend during the next cycle. When I say that, what I'm implying is that the current cycle has its last or late stage still to shake out. And for us, that speaks to kind of the dangerous situation that we find ourselves in, or the dangerous environment, if you will. That's why we're hedging pretty close to the money, the S&P, why we have a pretty big chunk in cash, why gold is our top individual position, stuff like that. We think we are responsibly allocating for all possibilities, even one where, we get that fabled soft landing, and asset prices just kind of continue to meander higher. We'll make money in that environment as well, or at least we should. So in the technicals, I want to touch on the dollar. We were bullish the dollar in August. We went to a neutral stance, but still, articulated some real upside potential there. And then we kept it neutral for October. And when we get to the charts, we'll see how it has rolled over. But neutral doesn't mean we're bearish. It just means that we weren't as bullish as we were, 2 months ago. Nevertheless, September saw, a rousing, strong dollar, and stocks having a negative correlation currently moved in the opposite direction. Last couple of weeks, the dollar has rolled over. In fact, that happens to be the chart in front of you there. And the S&P 500 has had a positive 2 weeks after like 4 consecutive down weeks. And it's up a little bit today on bank earnings. Our core portfolio, I mentioned gold. We've been scaling more into long-term bonds. They're way up today. So on a relative basis, the core's having an unusually good day relative to a lot of other things. But again, that's the short-term stuff that really isn't what we're investing for. GDP is going to come in very strong in Q3. And that's probably going to translate to very good corporate earnings in Q3. So that could be very bullish. Remember I said the other day that, we're kind of looking at a setup that could be positive for equities in the fourth quarter. Now, it's not so much the earnings surprises to the upside. It's what the outlook is. And if CEOs who, remember, are little more than shepherds of their own stock prices these days, if they come out with caution going into next year, and I think they should, the market might not take that so well. So it's not what you did for me in the third quarter. It's what you're going to do for me going forward. And if the executives of these firms that are going to be reporting in the few weeks to come are guarded in their outlooks, and we think they should be, Now that could be something that mutes what might otherwise be a pretty strong fourth quarter coming off of a very weak third quarter for equities. So then I'll just close with the same thing I've been saying over and over again, and that is that what seems to be inspiring stocks. Now, good earnings will be good, particularly when the Fed, and it happened again last night, I believe it was Waller, essentially said, we're done with rate hikes. We're as tight as we need to be, and we've been pretty restrictive, and we're going to stay restrictive. Well, what the stock market has been hearing when they hear those comments is, oh, the Fed's getting out of the way. Well, that's not what they're saying. What they're saying is they're very much going to stay in the way with these high restrictive interest rates, and they're going to continue to roll off their balance sheet to the tune of $94 billion a month. That's what they're saying right now. I am in the skeptic camp who says, yeah, they say they're going to remain tough. Well, let's just wait and see, because their DNA tends to have them panic when markets panic, and they tend to want to swiftly come to the rescue. Problem with that is that if they do that, they're not going to let inflation get sustainably to where they say they need it to be. So it's going to be real interesting to see these characters meander into the first 6 months or so of next year. If we do get some things begin to really shake more so than they have of late, how they're going to react to that. Interestingly, as I speak, I'm just looking at my screens. NASDAQ 100 is actually negative right now on the day. The S&P is still up about 29 basis points. Would not be a good thing for the bulls to see this rally fade today. I will note that the VIX is up 4% and the NASDAQ 100 VIX is up 3%. And that can be a harbinger of what may happen to close the day. So although I've seen this happen early in the session and then seen the VIX plummet and the market rise, but if that happens, I don't know if there's any Fed speakers out today, but man, they have been able to move the markets on an intraday basis. My whole point again is that soft language from the Fed tends to bolster the market. Soft language from the Fed, if that gets confirmed with concerning language from earnings announcements, we may be not too far from the market beginning to discount the earnings hits that come during recession. And that is kind of our thesis right here for more downside to come in the equity markets, is that it'll be economically induced, poorer earnings, we have high labor costs and so on and so forth, margins contracting, and then you have a problem. Inflation coming down, ironically, actually means when you have a higher cost structure, thinking wages as I say that, actually means compressed margins. You get a margin squeeze, profit margin squeeze there, and that could be problematic for stocks as well. There is a Goldilocks scenario out there. A lot of Wall Street people, I heard 2 people on Bloomberg this morning just kind of pound that narrative, and I'm sitting here thinking, okay, sounds nice and sweet, but it's going to be a tough one to pull off. So if it does, we'll do fine. If it doesn't, we'll be hedged so that we can't get hurt too badly, and be positioned to do very well coming out of it. Okay, so those of you who do not enjoy the technical stuff that I do here on the videos, feel free to click the X and get on with your day. Thank you so much for staying with me this long. The rest of you, I am going to just go through the technicals real quick of the S&P, NASDAQ, gold, Treasuries, and the dollar, but I am going to do it quickly. I think I'll just stick with the daily charts. Here's your S&P 500. There's that bear flag that didn't happen. Saved by the 200-day moving average. Popped up above the 20-day. You can see it's bouncing around between the 20 and the 50-day moving average. have a nice buy signal from a nice position here on the MACD. But this could roll over, and actually it would give us a bearish divergence right here if that happens. So the bulls definitely don't want to see that. But it does comport with what we said. Even in our equity market conditions index, which scored bearish, I did say the pretty good setup for at least somewhat of an October rally, and we've been getting that so far. And then on the NASDAQ 100 ETF that we track, again, failed bear flag, really pounding higher here. Didn't quite get oversold, but pretty good look there. Technically back above its 50-day moving average, testing that right here. Again, bulls don't want to see that roll over. It is rolling over a little bit here as I speak this morning. Nothing dramatic, but like I said, volatility is getting bid right here. In fact, now the VIX is up 5%, and the VXN, which tracks this index, which is the volatility price embedded in options, essentially that denotes defensive action among options traders. There's a lot that goes on under the surface there between the market and the dealers that can impact that as well. But right now, that would be a red flag for the market, at least today. Okay, so then just a quick look at gold. Gold was way oversold, has seen a nice bounce. This is your buy signal on the MACD. You can see I had a falling wedge right here, which by itself is a bullish pattern. Didn't really have any big divergences or anything to look at here, but we bounced, came out below that, came back, just gapped right through there, and now is resting just above the 200-day moving average. A big rally in gold, speaks to potential concerns and so forth. Gold has been trading on the prospects for real yields, and as real yields have gone higher, and that is the difference between interest rates and what inflation is, then gold has been coming down a little bit. But it trades on different things at different times. Sometimes there's a high correlation or negative correlation to the dollar. Sometimes all we need to focus on is the prospects for real yields and so forth. And then of course there's lots of other things to discuss, central bank buying and all those things, if you can get your head around some of that. But we do like gold. We started adding it in December of 2019. We think the dollar by necessity is going to need to trend down on a longer term basis. We think the U.S. government is going to need negative real interest rates, as they did in the mid 40s and early 50s, to fix a concerning debt to GDP ratio. So I mentioned that a little bit in the narrative the other day. Probably a lot more to come. Maybe we'll hit that hard in the year-end letter this year. 10-year yield. Remember we tracked this a little bit over recent weeks. Remember at one point I said, this was a pretty compelling rising wedge pattern. I expected it to come break below, and it broke out above. We had bearish divergences in the time, burned right through those. Looks like we might have got kind of a blow off top. I mean, you can make a case. Look at this big bar here from yesterday. We just had a huge move in yields. You can make a case that there's so much supply of treasuries going to hit the market going forward, and may not be a big appetite to buy them, which means the yields are going to have to be bid up, prices bid down. Yesterday, or this week actually, was just a mess. They had 3 auctions and none of them went off very well. And yesterday's was just kind of the straw that broke the camel's back. I think that had a lot to do with yesterday's decline in the stock market. Bonds got utterly hammered. Today they're coming back down to earth, right? So now it looks like yields are rolling over like we kind of expected in here. So we'll see. We, with our recession thesis going forward, we actually like long duration bonds right here more than we have in years and years. And there's a very legitimate narrative that counters that. I was listening to Mohammed El-Arian this morning, and he was asked, if we do get this recession, will yields react? And I knew what he was going to say. I'm nodding my head thinking, yes, of course, absolutely they are. And what I'm giving you is the, kind of the knee-jerk reaction that yes, yields are going to suffer and bond prices are going to soar. Treasury bonds in a recession. He's saying, I don't know, because of what I just said, because the supply, will there be buyers? He talked about China, Japan, blah, blah, blah. And I get that, and we're very sensitive to that, and we're paying very close attention to that, and it has serious macro implications. But no, I do think that when recession hits, I guess I should say if or when, we're going to, at that point, we're going to see a real bid for treasuries. Dollar will probably do okay, right? Although when yields plummet, suddenly the interest rate attraction to the dollar. Of course, it depends on what other countries are experiencing as well. I mean, Europe is in recession. Who knows? It may be coming out of recession as we are going into it. And that would be very bullish the euro for a lot of reasons. So the dollar actually could go down. So we'll see. Stay tuned. Again, we're not really backing up the truck on anything right here, but I'll be surprised if this time next year we're not very happy with our longer term bond exposure. And then the all-important dollar. Last time we looked at this, I showed you this uptrend here. I did also say that, we didn't have any issues on the MACD, but we were rolling over from very overbought conditions. Now we have our sell signal here, and you see what happened here. Huge bounce yesterday, consistent with that huge jump in yields. And today the dollar is still up about 12 basis points. We'll keep our eye on that. This is going to be something that we are going to be glued to. And if we're right on our thesis, and I think we're going to be, that's going to really help out the areas that we think already offer value, but we want to let the rest of this cycle play itself out before we take the kind of positions that we expect to be taking on a long-term basis going forward. Folks, thank you as always for watching and listening. I will be back, I'm sure, today or this evening with our weekly economic update. Have a great day. Bye-bye.